We're joined by Elise Roberts, president of Secure Today Financial and the featured expert on the new book, A Journey to Financial Security. We also have long-term care expert, Mr. Ed Roberts. And today we're gonna talk about how annuities can protect against risks that you may face in retirement. Things like healthcare, long-term care, and even market crashes. Elise, Ed, thank you so much for joining me here today. I wanna talk to you a little bit about taxes as well, because that's a part of annuities. Can you tell me a little bit about how annuities are tax deferred and how that can help clients?
So all the money that goes into an annuity is treated as if it's like your IRA, where you're not paying tax while it's in the account. It's only when you take money out, but you can use any kind of money. So if you have money in an annuity that's not an IRA, you don't normally have that tax shelter in another program, but in an annuity, it's 100% tax sheltered as long as the money's in the account. And let's say you start taking income in 5 years. The whole time it's there, it's growing tax sheltered, and even the gains are tax sheltered. But when you start taking money out, then you're taxed on the gain. Now, the way that works is it actually has some details, and we can get into some of that, but that money comes out and you're taxed on the portion that you did not put in, the part you gained. So you're only taxed on that.
And that's kind of interesting. I think a lot of people forget that one of the most powerful forces on this planet is compounding, right?
Yes.
And explain a little bit about how tax deferral plays into compounding, and maybe you can use an example like how a CD doesn't do that, right?
Right, a CD, if you put money in a CD and you earn 5% a year, at the end of the year, it has to go on your taxes. So you have to show that you earned the 5%, pay the tax on the 5%, then you start over the next year. With an annuity, you have the opportunity to compound that growth and not pay the tax. So now you're making money on the money without having to take some out and pay the tax. So you're compounding the growth and the interest. So you're not only just growing on the base that you put in, you're growing on all the interest. So that just allows you to have more money later to use, to take out, to live on, or other things that you might need.
And so, that's interesting because a lot of people think, well, if I leave the interest in my CD, I'm getting compounding. But even if I pay the taxes from somewhere else,
you still paid it.
You paid it somewhere, right? So you're losing that compounding somewhere else. Speaking of this compounding effect, talk to me a little bit about market volatility, negative compounding, especially when markets are down, and how an annuity can play a role there. Because I also want to talk a little bit about the uncertainty of long-term care and healthcare, Ed. But before we talk about those uncertainties, maybe we can talk about the uncertainty of Wall Street.
The beauty of some of the annuities. So let's just say there's 3 types of annuities. You got your fixed, and you've got your variable, and then in the middle you have your fixed index. That kind of gives you the best of both worlds. Your variable annuities are growing, your fixed indexed annuities are growing, your fixed annuities are growing. All of the money, because it's under the umbrella of an annuity, is tax sheltered. So let's say the market crashes. Now, the only one that really has the risk of the downside is the variable. So if we could just talk about the fixed and the fixed index for now, when the market goes down, you're not losing money. You may not make money, but when everyone else is losing, at least you get to start where you were, and all the money you made previously did not go down, and you get to start growing again once the market does come back.
So just to clarify, all 3 of these offer compounding because of the effect of tax deferral.
Correct.
But the problem with the variable side, you can lose money due to market fluctuations.
Correct.
On the fixed or the fixed index, I'm getting the compounding of tax deferral.
Without the risk of loss.
And yeah, I guess the worst thing to do is lose money on tax advantage assets, right?
Correct.
So speaking of the other thing that can take our money away, because if Wall Street is one of them, the IRS is the other, healthcare is probably the third.
And some of the annuities have a feature that'll allow you to get some additional benefit for long-term care, critical care, those things, and you don't pay any cost many times, some do, but you don't pay for the benefit, and there's no medical questions. But that's a limited amount of coverage. So what we do is we make sure that each client knows the value of having full-blown long-term care planning that's over and above the supplement that the annuities offer. And that's where Ed comes in.
And Ed, do you have a favorite, whether it's a supplemental benefit of an annuity or a long-term care insurance policy or an alternative to these two, or is it really different?
I think it depends on the person. The annuity-based ones that have have that secondary benefit are great. They're great, what I tell people, as a supplement, because if you're typically taking an annuity for income, you're going to plan on using the income. Well, even if I double that income, I don't have that income because I'm paying for my expensive care. So I've really cut myself twice. And in order for that number to really be big, it has to be a very large annuity.
Right.
So, it's a great supplement, but having a plan for long-term care is absolutely necessary. Again, you get various numbers all over the place, but the one that I heard is about 80% of the healthcare dollars you're going to spend in your whole life are the last 2 years. Right. So when something comes on, it's going to come on in a big way. Most people are not financially prepared at all. And having a long-term care plan says, I understand that this is an inevitability at some point, and how am I going to do that? What's that going to look like?
I like that, by the way, Ed. You didn't say long-term care insurance necessarily, because a lot of people are scared about that. It's just a plan for long-term care,
Correct.
Right?
Correct.
And I know one of my friends, he's married to a wife 20 years younger than him, and he says, that's my long-term care plan. That's probably not the best long-term care plan, but just having some sort of plan is probably the right way of going about this, whether it's insurance or something else. So I'll field this question to either one of you that wants to take it. Tell me a story of a client, a situation where an annuity helped them, whether it was long-term care, whether it was a market crash, whether it was taxes. One of you tell me one of those good, kind of make you feel good stories.
Well, I won't say from an annuity standpoint, but similar to an annuity, there's some long-term care products that will give you 200 to 300% of your own money with no risk, 100% refundability. So you stand no risk whatsoever. And that's for a longer conversation. But for the people I hear this quite a lot, they'll say, well, I'm self-insured. Yeah, you are. Do you know what that means? Well, no, I don't.
Yeah.
I mean, they really don't understand what that means. That, well, I'll just pay for it. I said, okay, what does that number look? I don't know. And there's a lot of this idea. It's not whether you're self-insured or not. It's whether you're going to be insured and how you're going to do it. That's the real question.
And that's actually interesting. So I guess the good story that we're hearing here, Ed, is even if they self-insure, knowing what that means is important, right?
What does that number look like? How's that? Part of whether it's an annuity or a long-term care plan is it gives you a plan. Well, if you have a plan to self-insure, you have no plan. You have a funding source, maybe.
But not necessarily a plan.
Maybe, but there's no plan because having the money is part of it. I tell people that another part that people don't know is that you need a mechanism to make the money work because you're 80 years old. You have a health condition. How do you think you're going to navigate that system?
Listen, ladies and gentlemen, obviously you can tell planning for the what-ifs of retirement is important. You'd like some more information? Just go to the website, theannuityshow.com, or give Elise, Ed, their team a call at 888-526-4184, or simply scan the QR code at the bottom of your screen.